Hi everybody, my name is Gary Yao, and today I would like to share with you why I think the Federal Reserve will most likely crash the stock market before we ever consider crashing the real estate market. And that is not because they want or don't want. It's something that will most likely happen because of the choices of their policies. So the Federal Reserve is balancing between two things that are quite opposite. One is fighting inflation, and the second one is helping the economic growth. Now, how did we get here? When 2020 happened, the economic growth of the US was in danger because we have a mandate that everyone has to stay at home and isolate each other because we didn't want this virus to spread. When doing so, in order to calm the dangers, or I guess the mindset that we were afraid that we're going to halt our economy, people will not be productive and we will stop spending, because after all, this is a consumer economy. Well, in order to help with that, the Federal Reserve start printing out money and giving stimulus checks. We have a lot of money flowing into the system. In fact, it is said that in these short 2 years, we print out anywhere from 20% to 33%. That means that on the high end, we print out 1/3 of all the money that is in circulation in just a short 2 years. Can you imagine how much is that? So what is the Federal Reserve to do now? Hang on. In this situation, the Federal Reserve have one thing that they can do, and that is increase or decrease the interest rate. When 2020 happened, they dropped the interest rate to 0. There were talks about getting to negative interest. Good thing we never did. But when interest rate dropped to 0, the mortgages actually dropped to 2%. So how does this work? The Federal Reserve let the banks borrow money for 0%, and then the general population will borrow money from the bank at 2%. Well, 2%, 2.5%. It was as low as 2.2% until the end of last year, and it has been increasing steadily up to 6.25 last month. This money dropped to 5.25, give or take. So what is happening right now? Now the Federal Reserve need to fight inflation. In order to do so, they're going to increase, they're going to increase interest. Okay, interest rate. That's the tool that they have to. Of course, they can print more money, which we don't want. How does it affect the stock? Well, let's say that the interest rate right now is what? The interest right now is 5%, 5.25. It is said that by the end of this year, the interest rate will go anywhere from 10% to 13%. If that happens, it means that less people will borrow money to buy houses, right? If less people borrow money to buy houses, it means that then sellers have no incentive to sell their houses because, well, houses are going to drop from the peak, and if they're going to sell for less and then have to go on the other side to be a buyer, then there's no incentive. So we're going to see a crash, perhaps not on prices, but on crash on transaction, where the buyers cannot afford to buy and the sellers are not interested in selling. So that's what's going to happen in real estate. Doesn't necessarily it's going to crash the market, is it? Because it's not going to be a 2008 all over again. It's going to just be a halt where the two parties do not come together to make a transaction. So let's talk about the stock market now. At 10 to 30% interest rate, let's say that businesses will have to borrow money at a higher price. And because a lot of these publicly traded companies started to have cheap money, for one. They start to receive cheap money not for free, but they could borrow, and because of inflation, the money that they have today, they could borrow at a longer term for cheap. That means that it was easy to show in your books that you were making money. Second, there was a lot of people that have free money in the forms of stimulus checks and whatnot, where they could, with the spare money, start buying more stuff, mainly bags, cars, and look into what happened to the car. We have the car industry where they have a lot of repossessed cars. So the car industry seems to be crashing. So they bought cars and they also invested in the stock market. It is said that in 2020, a lot of these online companies, Robinhood, Ally Bank, all these online venues for trading stocks, they have a boost. And what's happening right now? A lot of these people who invest in stock, they're pulling the money out because they need to buy their necessities. They need to buy for, pay for the rent, food, clothing. They needed that money, which that free money, they just help it artificially create a huge boom in the economy. But what we see right now is that a lot of these publicly traded companies are really not that profitable, but they got bigger because people were flooding into their bank accounts, their corporate bank accounts with money, thus allowing them to expand artificially. What we see now with a high interest rate is that these companies were not profitable, were not giving a service or a product that people really wanted because there was no proof of concept. It's just a concept. For example, a lot of those electric cars that went to the market, these stocks went higher, but right now we still don't see many electric cars. We see kind of like having Tesla, but that's pretty much it. And a bunch of half a dozen electric car companies that are not no longer doing business. They actually just fade out. So what is the government to do? What is the Federal Reserve doing that causes me to believe that they want the rather crash the stock market and crash real estate? Is because a lot of these companies are going to go bankrupt. And when a lot of these companies go bankrupt, it's going to clear the space so that the profitable ones, the ones that survive this mayhem, they will be able to reap the rewards of getting lower interest rate. What do I mean? After the inflation is manageable and controlled, the Federal Reserve is going to bounce back and drop the interest rate. Interest rate is going to drop. We believe that between 3.5% to 2.5%. And I'm talking about strictly this is for 30-year loan a 30-year mortgage loan. Why do I use this as a base? Because that's what I do. I look carefully into real estate. So if the interest rate for a 30-year loan is 3.5 to 2.5, you best believe that the corporate loan that they receive from the bank to expand their business is going to be around that rate. So the businesses that are leaner and meaner are able to stay profitable in this upcoming recession, with many things that we're already here already in recession, then that means that these businesses are going to have cheap interest rates if they are able to weather storm and get bigger market share. When that happens, well, we'll know that real estate is going to go higher because a lot of these buyers will be able to buy at a lower interest rate. Therefore, we can see that the stock market is most likely going to drop before the real estate market ever is going to drop. And with that, I would like to say that save, stay in cash for now, and just be vigilant. If you happen to buy a house right now, most likely if you are able to pay for it, then your home value is going to go higher once the interest rate drop, because then it's going to a lot of buyers, especially millennials who are getting married and having kids, they will be the ones who create more demand. As baby boomers exit the market as empty nesters and going to the next stage in their life, it's going to this supply is going to be overtaken by the huge demand that we're seeing. So this is Gary Yao, and I will talk to you soon.